Warren Buffett once said he pays a lower tax rate than his secretary. And you know what? He's not lying. But here's the thing that most people get wrong. The wealthy aren't cheating the system. They're not doing anything illegal. They're simply using strategies that are written right into the tax code, strategies that are available to you too if you know where to look. Today, I'm breaking down exactly how the rich legally pay less in taxes, and more importantly, how you can start using these same strategies right now, even if you're not rich yet. Because here's the truth. Tax strategy isn't just for millionaires. It's for anyone who wants to keep more of the money they earn. Before we dive in, let me be absolutely clear. Everything I'm sharing today is legal and legitimate. I'm not talking about hiding money in offshore accounts or sketchy schemes. I'm talking about using the tax code the way it was designed to be used. And as always, this is educational content. You should consult with a tax professional before implementing any strategy. Now let's get into it. The first thing you need to understand is that the tax system is designed with incentives. The government wants you to do certain things like start businesses, invest in real estate, save for retirement, and create jobs. So they reward those behaviors with tax breaks. The wealthy understand this game. They organize their financial lives around these incentives. Most regular people just earn a paycheck, pay their taxes automatically, and never think about it again. So let's start with the most accessible strategy that almost anyone can use right now. Maximize retirement accounts. I know this sounds basic, but most people are leaving massive amounts of money on the table here. When you contribute to a traditional 401,000 or traditional IRA, you're reducing your taxable income dollar for dollar. If you're in the 22% tax bracket and you contribute $10,000 to your 401,000, you just saved $2,200 in taxes. That's real money, but here's where it gets better. If you're self-employed or have a side business, you can open a solo 401,000 and contribute up to $69,000 per year as of recent limits. That's not a typo. $69,000 that comes off your taxable income. Wealthy people max these out. Regular people often contribute the bare minimum or nothing at all. Then there's the HSA, the health savings account, which is honestly one of the most underrated tax tools out there. If you have a high deductible health plan, you can contribute to an HSA and get a triple tax benefit. The contributions are tax deductible, the money grows tax-free, and if you use it for qualified medical expenses, the withdrawals are tax-free. It's the only account in the tax code with this triple benefit. Wealthy people treat their HSA like another retirement account. They max it out every year, pay for current medical expenses out of pocket, and let that HSA grow for decades. Now let's talk about what really separates the wealthy from everyone else. Business ownership and expenses. When you're an employee, you get paid, the government takes their cut, and then you live on what's left. But when you own a business, you earn money, you pay your expenses, and then you pay taxes on what's left. That difference is absolutely massive. Here's a real example. Let's say you're a W-2 employee making $70,000 a year. You pay taxes on that full $70,000. But let's say you have a side business that brings in $70,000 in revenue. You have $20,000 in legitimate business expenses. Home office deduction, equipment, software, mileage, professional development, part of your phone and internet bill. Now you're only paying taxes on $50,000. You just made $20,000 in income essentially tax-free by covering your business costs. The wealthy take this to another level. They structure their lives so that many things they pay for anyway become business expenses. They travel for business and deduct it. They network over meals and deduct it. They maintain a home office and deduct it. They drive vehicles for business purposes and deduct them. They attend conferences and educational events and deduct them. Everything is legitimate and documented, but they're strategically structuring their spending to maximize deductions. And you don't need to be a millionaire to do this. If you have any kind of side hustle, freelance work, consulting, content creation, or small business, you can start implementing these strategies immediately. The key is proper documentation and making sure your expenses are ordinary and necessary for your business. Now let's talk about something more advanced but incredibly powerful: real estate. The tax code loves real estate investors, and there's one word you need to know: depreciation. When you own rental property, the IRS lets you depreciate the building over 27.5 years for residential property. This means you get to deduct a portion of the property's value every single year, even though the property is probably actually going up in value. Here's how wild this is. You could own a rental property that's cash flowing every month, appreciating in value, and your tenants are paying down your mortgage. But on paper, because of depreciation, you're showing a loss. That loss can offset your other income. This is why you hear about real estate investors who make hundreds of thousands of dollars but pay very little in taxes. It's not magic, it's depreciation. There's also something called a 1031 exchange. which lets you sell one investment property and buy another without paying capital gains taxes, as long as you follow the rules. Wealthy real estate investors use this to continuously upgrade their portfolios without ever triggering a tax event. They're building massive wealth and deferring taxes indefinitely. Let's talk about investment income, because this is another huge area where the wealthy have an advantage. The tax code treats different types of income differently. Your salary or wages get taxed at ordinary income rates, which can be as high as 37% federally. But long-term capital gains, those are gains on investments you've held for more than a year, are taxed at much lower rates, 0, 15, or 20% depending on your income. Wealthy people structure their compensation to minimize ordinary income and maximize capital gains. They hold investments long-term. They harvest losses strategically to offset gains. They understand the difference between qualified and non-qualified dividends. They're playing chess while most people are playing checkers. But here's the thing, you can play this game too. You don't need millions of dollars. If you're investing in index funds or individual stocks and you hold them for more than a year before selling, you're already benefiting from lower capital gains rates. If you have investments that are down, you can sell them to harvest the loss, offset your gains, and even deduct up to $3,000 against your ordinary income each year. Another strategy the wealthy use is bunching deductions. If you're close to the standard deduction threshold, which is pretty high now, you might not be itemizing. But if you bunch your charitable contributions, your medical expenses, and your state taxes into 1 year, you might be able to itemize that year and take the standard deduction the next. You're basically timing your deductions to maximize the benefit. Charitable giving is another big one. When wealthy people donate appreciated stock to charity instead of cash, they get to deduct the full fair market value of the stock, and they never pay capital gains on the appreciation. It's a win-win. They support causes they care about and get massive tax benefits. Let's talk about business structure for a minute, because this is something that can save you tens of thousands of dollars. If you have a profitable side business and you're running it as a sole proprietorship, you're paying self-employment taxes on all your profit. That's 15.3% right off the top for Social Security and Medicare. But if you elect S-Corp status, you can pay yourself a reasonable salary, pay employment taxes on that, and then take the rest as distributions, which aren't subject to self-employment tax. For someone making $80,000 in profit from their business, this could save them over $10,000 a year in taxes. That's a significant amount of money. The wealthy also understand timing. They understand when to recognize income and when to defer it. They understand when to take deductions and when to carry them forward. They work with tax professionals throughout the year, not just in April. Tax planning is proactive, not reactive. Here's something most people don't think about: education expenses. If you're improving your skills in your current field, those education costs might be deductible. The wealthy are constantly investing in themselves, learning new skills, attending seminars, and they're writing off those expenses legitimately. And then there's the concept of paying your kids. If you have a legitimate business and your kids do legitimate work for it, you can pay them. For 2024, a child can earn up to the standard deduction amount, which is over $14,000, and pay 0 federal income tax. Meanwhile, your business gets to deduct that as a wage expense. It's a legal way to shift income from your high tax bracket to their 0 tax bracket, and you're teaching them about work and money. Now, I want to address something important. Some people hear these strategies and think the system is rigged or unfair. And look, I understand that perspective, but here's my take. These strategies exist because the government wants to incentivize certain behaviors. They want people to save for retirement, so they give tax breaks. They want people to start businesses and create jobs, so they give tax breaks. They want people to invest in real estate and provide housing, so they give tax breaks. You can complain about the system, or you can learn the rules and play the game to your advantage. The wealthy choose the latter. And the beautiful thing is, most of these strategies scale. You don't need to be making millions to benefit. You can start implementing these right now wherever you are financially. So here's what I want you to do. First, maximize your retirement contributions. If you're not at least getting your full employer match, you're leaving free money on the table. Second, if you have any side income at all, make sure you're tracking your expenses properly. Every legitimate business expense is reducing your taxable income. Third, think about your investment strategy. Are you holding investments long enough to get long-term capital gains treatment? Fourth, consider working with a tax professional who thinks proactively about strategy, not just someone who files your return once a year. The difference between paying 30% of your income in taxes and paying 20% is life-changing over time. On a $100,000 income, that's $10,000 a year. Over 30 years, invested properly, that's over $1 million. That's the real cost of not understanding tax strategy. The wealthy aren't smarter than you. They just have knowledge that most people don't have, and they use that knowledge consistently. But now you have this knowledge too. The question is, what are you going to do with it? If this opened your eyes to legal ways to keep more of your money, hit that subscribe button. We're dropping content every single day to help you build wealth and financial momentum. And drop a comment with your biggest tax question. I read every single one, and your questions help me create content that actually serves you. Remember, taxes are your largest lifetime expense. Learning to minimize them legally is one of the highest return investments you can make. Now go take action, consult with a professional, and keep more of what you earn. You've worked hard for that money. You deserve to keep it.